Hey guys, Mike with Mortgage Nerds here in Appleton, Wisconsin. I am here with...
Brian Hofmann with Mortgage Nerds as well.
Yes, you are. Today we want to talk about a really cool topic, but how we got to this topic, I was analyzing data from last year. It's 2021, last year being 2020, looking at our closed loan pipeline and where everything came from, and found a really cool little nugget. We did 8 loans for financial advisors last year. So that's pretty good. So financial advisors are recognizing that, you know, we're a good resource, rates, costs, all that kind of stuff.
First,
yeah.
we?
Well, when I say we, I mean
Me.
you, right? That being said, can you remember something that they all had in common?
Yeah, so the first thing that would come to mind is every one of them, equity in their home.
Yep.
Every one of them did a cash out refinance.
Yep.
Every one of them, when we received the appraisal back, took all of the money that they possibly could, up to 80% loan to value.
So let's talk about that, because that gets a little maximizing that benefit, right?
Right.
If you're going to do a cash out refinance, let's just use a number. You have a $100,000 house, means you can go up to $80,000, right?
Yeah. So if you owed $50,000 on your current loan,
Right.
and you can go to 80, you have $30,000 of equity that you can use,
Right.
leaving 20% left in the house.
But what if I only need 10? I'm just going to fix up my basement a little bit. I just want to take 10.
Sure. But this is where the financial advisor is using that part of their equity to help themselves build wealth.
Right. See, the thing about a cash out refinance as well is that you take, in most cases, a slightly higher rate, or there can be more costs associated with it. So there's like a loan level pricing adjustment, they call it,
Right.
for a cash out refinance. You get a little bit better terms on a rate and term.
Correct.
So once you go cash out, which cash out is anything above $2,000,
Oh, yeah.
$2,000. Anything above that, and you're taking the cash out hit, you might as well maximize it, right? It doesn't matter.
Right.
So
Another thing to think about too is if you're having a rate, say in the low 3s or high 2s, right? If you can't make more than that, or history tells us
Right.
when you invest, you're going to make more than high 2s, low 3s on your investment.
right.
Well, you're actually making money then off of taking that slightly higher rate to invest those funds.
And yeah, and then that's what the financial advisors are recognizing.
Exactly.
They're like, obviously rates are low, I want to refi.
Obviously, there's risk. I mean, the market doesn't always make money, but historically, over time, it's proven.
I was gonna say over time,
Yes,
it always has.
It always has. So
And-
it's not as great of a risk as people think.
2 things. So the cool thing about buying a home, it's still an investment, but it's the only investment that you can live in, right?
Right.
So that's the cool factor there.
You know, and another thing to look at too is when you cash out your house, right? It doesn't matter if the market even pulls back. Let's say the market pulls back and now you lost your equity, that 20% that you were in there.
Yep.
That only matters is if you have to sell, you have to leave your home at the time that the market's down.
Right.
The market's on a cycle as well. And if you don't have to sell, you're fine if the market drops back, and because it's going to come back again. And not only that, you only realize the equity in your home if it's paid off, if you cash out, refinance your home, or you sell it.
That's why I always call it perceived equity.
Right.
Because if you're not planning on selling it or refinancing it or whatever, if there's not an action that's taking place to tap into that equity, it's just perceived equity, because until you have an appraisal or do some type of action, you don't know for sure. It's just
Right.
an estimate.
Absolutely.
But that's a great point. Just like your investments, they go up and down. And when you're living in a home, it can go up and down, even though it's been going up.
Yep.
Even if it does come down, it's okay. You're living in your investment.
Sure.
That over time will come back. As long as you don't have to sell or whatever, then you should be coming out all right.
On a side note, even in this purchase market right now, which is absolutely insane, and everybody's offering $10,000, $20,000 over list price and whatnot, and paying the difference in appraisals, right? Well, if somebody's willing to do it and has the funds, and they know they're going to be there a while, let's say they have a stable job and they're not going to have to worry about selling,
Yeah.
even if the market pulls back, it doesn't affect you as much as it does if you wait or
Keep waiting. It's
exactly.
the cost of waiting, right?
So that was a side note, but as long as you're not leaving, it really doesn't matter what the market does.
No.
It helps that you got a better price on the home, maybe,
Right.
but it doesn't mean your house isn't going to be worth more some point in the future, because history tells us that as well.
Yep. And again, life can happen though. So even though you don't plan on leaving, you may end up leaving.
And you have to be prepared if that possibility arises.
Right. So let's talk about that. So financial advisors are looking at the benefit. They cashed out all their money, right? And then they're taking that extra funds from what, some of them were actually fixing up their home, and some of them were actually buying more property, but any extra funds, because sometimes the appraisal came in at more, right? The extra funds that they had, they would invest, right? So the investing is liquid, so you can cash those investments in. When you actually pay down your mortgage or leave that money in there and have more equity, you can't tap into it very easily.
No, and it costs money to refinance, and it costs money to,
Even if you're getting a line of credit, they want to know that you're working,
Right.
That you have good credit. But when life kicks you in the teeth, you may, you're off work, you miss a few payments, you're like, I need that $50,000 in equity that's my home.
Right.
I need to refinance.
Now you can't.
So leveraging yourself based on risk means, big long mortgage. Google it up. It's a fantastic term. But not putting too much money into the home, keeping yourself liquid, investing, like you said, over what your interest rate that you're getting.
Right. Absolutely.
That's how to leverage yourself the best possible way using a mortgage.
Right.
And that's what we do as mortgage advisors. We get your story, long-term plans. We figure out, a plan specifically for you and how to best use your mortgage to build wealth.
Absolutely. And another thing too is to maximize what you're doing with a cash out refinance, your credit score needs to be there, right?
Oh, really? What's a good credit score?
Well, I mean, maybe to go like over 700, you'd be looking at cash out.
700, that's a pretty good score.
Why did you just put that hat on?
What do you mean? What hat? The My Credit Guy hat? This one?
Yes.
Oh, I just like wearing it because they're amazing at what they do and fixing people's credit and getting their scores up so they can do cash out refinances at less of a loan level price adjustment, and they really know what they're doing.
They do.
They do.
Yeah.
Was that weird?
Anyway.
Love you, Sam Parker. And what else about the benefits of cashing out, maximizing that? One left. So if you own a home, or even actually if you're close to owning a home, you should, at this point in your life, at least talk to a financial advisor, right? It's worth that conversation to get your mind thinking in the right path and maybe break down some of the barriers, some bad information you've got in your teens.
Absolutely.
Whatever.
Let them show you what history tells you with compounding interest. I mean, I have a customer right now talking to a financial advisor, making $130,000 on the sale of their home.
Nice.
And now they're looking at going like, do we put all that towards the new house? What do we do with those funds? And that's where I can give them some advice, but they're going to get real numbers and real data from the financial advisor to help that $130,000 work for them.
Right.
So if they don't want a home, instead of doing a 15-year mortgage, invest those funds. Now at 15 years, you want to pay your house off? Sure. Pay it off, but now you actually have money that you made off of that.
Right. And you don't even have to if you don't want to.
Exactly.
Let's say it was 12 years.
Just let it keep making money for you.
Yep, your investments did well. You could pay it off even sooner, but you're like, no, I'm good. I'm just going to leave it. Right? You have that advantage.
Exactly.
So yeah, talk to a financial advisor. It's worth the conversation. And if you do own a home, and you're accumulating some assets, you definitely need to talk to a financial advisor, and that's what we do here too. We have a financial advisor that we really know, like, and trust. And you mentioned data. We, for us to just say, oh, it's better for you to do this, what does the data show? That's why we think it's really, really important
Absolutely.
to have that conversation and align the two. So if you guys want our financial advisor's information, if you guys are looking for one, otherwise ask around your friends and family, have that conversation. It'll be well worth it. We good?
We're good.
All right. Remember, mortgages are complex.
let Mortgage Nerds give you the answers you need.